Welcome everyone to a new ATFX Connect video and a new market update. I'm gonna give you a quick review on what is going on the markets, macroeconomical data, results, movements on the price, situation related with equity, fixed income, commodity, crypto, forex, absolutely all assets, absolutely everything. Let me start sharing the screen with you, and please remind that I always got a post here. If you go to X or the old Twitter and you find ATFX Slice Down Connect, you will find our account, and I'm keeping you completely updated on social networks about every single thing that's going on, comments from central bankers, interesting movements on the price and so on. And remember, also on the blog of the website, you got the quick update every morning, plus the newsletter. In case you want to join the newsletter, just send me an email and I will include you in my newsletter for all fresh macroeconomic news every single morning. So back again to the charts. As you can see, US market is open right now. We can see that it's making a kind of lateral movement. This is Nasdaq 100, but if we go to SP 500, we can see that actually it's doing very similar movements. The price, the maximum of the price, the maximum achieved during the last uptrend, it was on Friday, last Friday. Since then, the last 3-4 days has been moving in certain runs of price, not broken up next maximums. In the case of SP 500, below 4,600 points. I would like also give to you, before I continue with the charts, I would like to give to you also few notes in terms of fundamentals, macroeconomical vision behind of this. Very interesting thing is take a look on how the market is actually discounted, and especially the US market is discounted this perception that labor market is going weaker and weaker, and therefore there is no need to continue with the interest rate hikes. Not even that, even assuming that somehow in short term, middle term, Federal Reserve will take a more soft position and even announce a kind of monetary stimulus, or which is translating in other words is interest rate cut. Why I'm saying this? Because if we take a look to the charts, it's not just because the equity markets are super strong right now. I mean, this is SP 500, this is Nasdaq, but take a look also how is reacting fixed income. If we go to 10 years bonds, is rising. So I mean, falling the yield, therefore rising the price of the bond. Which means like it's in line with the movement of lower interest rates. So we got equity rising, we got also fixed income dropping in terms of yield, which is adjust very well with the idea that again the interest rates should be could be cut off in the coming months. Not even that, there is another factor that I also listed you in the fundamental points, which is the price of the oil. If we take a look on the price of the oil, you will see that West Texas oil is literally plumbing, is falling and losing every single support, and it looks like they're probably gonna get close to the $65 per barrel soon, based on the evolution they are following. And why I'm saying this is interesting, or why this is related with the movements on fixed income, the equity, and also the Federal Reserve expectations, simply because oil is the mainly inflationary asset. If the oil is rising, inflation is rising by default, by definition. And if we got an oil price that is dropping constantly for the last 4 weeks, again, the threat of new inflation wave, it's gone. It's away. It's keeping away at least that risk of inflation, of new inflation. And therefore, I think Federal Reserve is feeling more confident with this situation, with this kind of confluence of different situations on different markets, the commodity. The dollar is also getting weaker and weaker. So therefore, I will say that the whole configuration, let me show you also the dollar. So we're gonna have the whole picture of all markets here. As you can see, the dollar is trying to recover certain levels, but still super weak compared with the previous month, and not even talk about what we achieved by the end of October, which it was almost 108 points. Since then, has been getting weaker and weaker, and therefore the price of the commodities are adjusting to a lower dollar, and the lower dollar means let's say the drop on the value of the dollar is by default telling us that the Federal Reserve is not planning to increase pressure on the monetary policies, because if they will do so, the dollar will discount uptrend movements, and is not doing that. It's actually doing the opposite. So that's why I believe the situation right now is this. I think it's really clear. In terms of Europe, because I just mentioned to you the situation of the private labor report, ADP, payrolls published yesterday, so also weakness on the driving force. We also got two another factors, additional factors that can show you that actually labor market is getting weaker, but it's even a positive reading in terms of inflation, because one of them, first of all, it says the productivity increased by 5.2% in the United States, and the labor cost declined by 1.2%. If the labor cost is declining and the productivity is rising, it means like the impact on the economy is lower, and also inflation is less likely to happen if the labor cost is dropping, which is the salaries and so on. In terms of Europe, France trade deficit narrowed by 8.6 billion in October. Italy, this is important, industrial production from Italy again dropped by 0.2% monthly in October, following the upwardly reviewed 0.1% rise in September, and coming slightly better than the forecast of 0.3% drop. Just slightly better than the expectations, which it was minus 0.3%. It was minus 0.2% industrial production in Italy. But unfortunately in Germany industrial production falls by minus 0.4% month to month, month over month. For October 2023 is the fifth consecutive month in a row that is decreasing the industrial production of Germany. And in my eyes, it confirms that the German economy, and therefore European area, because Germany is the main economy in Europe and is also the main industry of Europe. So the industrial production of Germany is dropping. It means the industrial production of Europe is dropping, period. More details, exports from China unexpectedly grow 0.5%. Super good news, because just as a reminder, the last trade balance that China was giving for the last two periods, it was so negative. It was minus 14%. The last one was minus 9% in exportations. And finally, we got plus 0.5%. Better even than the expected numbers, and therefore it's a good sign for the Chinese economy, which is the second biggest economy in the world, and it was also affecting, irradiating to the whole Asia area. I'm talking about Japan, South Korea. These two economies were getting a slowdown because of China, mainly because the industry of South Korea and Japan depends on the demand done by China. So if China is slowing down the economy, the Japanese economy and South Korea economy are getting less demands from China's side, and therefore the production drops in both countries if they don't see that is actually moving forward. Very interesting comments in terms of commodity and oil. As you can read here, it was, well, I was about to say accusations. It's not actually accusations. It's just an article published on oil.com that is mentioned Goering and Rosengang investment firm Brights. Sorry for my German. It says basically, and I quote, when the realization downs that oil and gas demand is not in free fall, investors will be forced to confront how little the industry has invested to offset the declines. Is this investing firm specialized in commodity, gas and oil, is saying that it's a big mistake what the authorities, governments are doing, particularly in West countries, with the industry. They also say here the price of crude oil continues to plummet. Oil producers accuse the EAI, which is the International Energy Agency, of manipulating the data. The investment world is divided. And they also say here, let me see, in 12 of the past 14 years, the International Energy Agency, according to the investment firm, has underestimated the oil demands by an annual average of, get ready, 820,000 barrels per day. It's a massive mistake. It's actually the equivalent of a country, demand of one of the small, middle-sized countries in terms of oil. So I think that's all. I also I didn't show you the Bitcoin, by the way. Super interesting, the move of the Bitcoin. Super strong and keep rising in uptrend, but even breaking up the resistance of that uptrend, and is going even farther and farther, which looks super interesting and amazing. Gold, the last one I didn't mention neither, dropping, and now it seems to be that the 2030, 2040, 2050 seems to be a kind of support right now, because we saw earlier this week on Monday morning, when the Australia and Asia were open the markets, how the gold was rising about $2,140, even $50 per ounce, and now it's dropping to $42 per ounce. And still, those $20, $50, it seems to be a kind of a barrier now, and work as a support. So let's see how it's evolving, the situation with this market, but it looks super interesting too. And again, it's in line with a weak dollar. If all these things change, if tomorrow by any chance we got the labor data from United States actually show us labor market is stronger than expected, this whole picture, bonds, equity, dollar, gold, and could change dramatically, could just switch from one size to another on the market. Okay, I think that's all. Take care, and remember, if you want me to keep you updated by emails, just send me an email. I will have you on my newsletter list, and I'm gonna send you freshly every morning a compilation of the news, macroeconomical news, that you can just follow to keep completely updated. Okay, take care and good luck with the market. Bye bye.